Hello, everybody. Today we're going to do the classic valuation of Amazon, which always just blows my mind of what people value Amazon at. Maybe I'm the dumb one here, but I just, I had to, even though I could just look at the price to earnings ratio on this one and the price to earnings growth ratio and kind of decide for myself, Amazon's a little bit overvalued. Even as much as I love Jeff Bezos, economically, I love Jeff Bezos. I still had to value just to, just for practice or whatnot. So we're gonna start with a methodology that I use for every valuation in these videos is net income past 5 years, and then take a combination of a few different compounded annual growth rates over here. And the 1, 2, 3, 4, the 5 I use are net income, operating cash flow, free cash flow, earnings before tax, and revenue. So let's start off looking at Amazon's net income 5-year CAGR, as I call it. I don't know if anyone else calls it that, but if you hear CAGR, I'm talking about the compounded annual growth rate. And the net income is growing, when you use the CAGR formula, 110% per year. So from 2015, their net income was $596 million. Now it's 11.58 billion in the most recent full year of 2019. So that, if you look at that one compared to the other ones, you see somewhat of a consistency between the operating cash flow and the free cash flow, and the lowest being the revenue. I think what accounts for the super high net income growth is not only is their revenue growing like crazy. Down here you go from 107 billion to 280 billion in 1, 2, 3, 4 periods. And look at this is profit margin right here, net income over revenue. It's grown tremendously from 0.56% to 4.13%, which is crazy since they're growing. I mean, they're growing so quickly and also becoming more profitable at the same time. I'm not sure if we can still call Amazon a new company or not, but pretty impressive and pretty good for investors. Now, what I did, I looked at these and saw even the earnings before tax is pretty extra. Compared to the other 3 conservative ones, earnings before tax is growing at a 72.8% CAGR, which is honestly my favorite metric because you take out the tax, you truly see cash flow before tax. Some people use EBIT, which would be operating cash flow. So some people would argue that operating cash flow is even better, but I mean, interest is a real charge. So I do kind of like to put some weight towards the earnings before tax. So that one's, but it's still so high. I don't see any company maintaining that for 10 years confidently. So I said it's possible. This is just my educated opinion. Optimistically, I am okay with saying their net income will grow 40% per year for the next compounded for the next 10 years. And then we'll assume a low perpetual growth rate to help make it a little more conservative of a estimate. I said worst case scenario. I mean, I can't imagine Amazon only having a 20% growth rate when you look at their profit margin growth. But worst case scenario, I put it in there for 20%. So right now, as of December 22nd, 2020, the market price for a share of Amazon is $3,206.52. I, using my optimistic and pessimistic estimations, which you can see over here. It continues off the screen. It's not really important to see, but it does continue for till 2029, and then I have the terminal value. So that when the optimistic came out to be $3,153, which is actually, compared to most growth companies, my optimistic is usually much lower than that. My pessimistic, however, is much lower at $813. If you could get Amazon for that, that would be a no-brainer in my opinion. If you can get Amazon for anything below this $3,153 as of this date, I'm pretty comfortable with that. I use my discount rate, this is just personal. I don't use weighted average cost of capital. I don't use, what do other people use? The 10-year government rate of a 10-year government bond. If I'm going to invest in a company that I don't have control over, I put this in my past videos, I want at least 12% return, because that's the average of the S&P 500 for the past, I forgot how long history. That's just the number I've always used. That's just also assuming reinvesting in dividends. So, and since Amazon doesn't give dividends, I would expect them to grow at more than 12%. So that's also the discount rate I use. You can change that if you want. I don't change mine according to any benchmark. That's my required rate of return. Okay, so finally, but not least, I'm going to go to the assets and the liabilities and equity from the balance sheet, which I use those for creating my financial health ratios over here. And so anything in the blue is just what I literally transferred from the balance sheet, from their most recent 3Q, 10Q. So current ratio 1.10, which is I'm not really sold on that. I think it could be better, but it looks like what hurts them the most is just they have a lot of long-term debt, which is, not unheard of, but that's going to put a lot in the what am I trying to say here? That's going to affect you when it comes to the current portion of the long-term debt. So, and they have a lot of other stuff on their balance sheet. Obviously, the debt current is 1.3 billion versus, which is a lot of debt. Their current liabilities, which is this, and there's a big difference there of stuff they're hiding on the balance sheet. Whether that's good accounting or bad accounting, it's not up to me to say, but there's a lot of current liabilities going on there. And however, they do have a positive total equity, so that's one of my requirements as well. And the quick ratio, which is gonna be lower for Amazon, since they're literally an inventory, they're literally a distribution company, so that's going to be 0.86, which isn't too bad. Tangible book value per share, which I calculate as total equity minus goodwill minus intangible assets all over number of shares. So per share, you have an actual tangible book value of $86.62, which is nothing compared to the price. This is an interesting thing I always look at, that I came up with this metric, intangible and goodwill to total assets. Even though this seems low compared to their total assets, the intangible assets only make 8% of it, which isn't bad for any new company, any modern company really. They usually inflate their balance sheet so much with goodwill and intangible assets. And then down here, 3-year average for free cash flow per share is $30.13, which is also, once again, hardly anything compared to the price. But when you factor in growth possibility, it's only a little bit overvalued with my rather aggressive discount rate. So not necessarily a bad buy, even with the price it was now. And then one more thing, my projections, I put a little bit more weight towards the fourth quarter coming up just because of holiday season. Obviously, Amazon's going to go on a killing spree, not literally, but killing spree when it comes to net income. So I have projected revenue. It'll be interesting to see how close it is to this. $369 billion and 54 cents, which, let me see. I don't have it in here. I was going to say, does that go along with the same revenue CAGR, but I'm not 100% sure. Looks like net income is going to be, make sure it's lined up, 19.987 billion. So let's see, it's going to surpass my optimistic already this first year. So if something drastic doesn't happen in Q4. So I didn't, when I first made these optimistic and pessimistic numbers, I'm not going to change them because of COVID, but I'm sure COVID will have a short-term boost on Amazon's numbers. So yeah, that's my valuation on Amazon as of December 22nd, 2020. And I have it as technically a sell right now, but still, I'm using an aggressive discount rate. So it's up to you. I don't think you can go wrong with Amazon, but it's technically outside of my range. So everyone's range is different. So thank you for watching.